Okay, thank you very much for everybody involved, and I really appreciate this opportunity to come in and discuss market profile as it is today versus what we did when we started out. And when we started out with market profile, we probably could have introduced it in a better method in terms of defining what it does rather than try to apply trading decisions to it that we started out with. So today, I'm going to start out by looking at market profile and telling you the changes that have taken place in the market and the adjustments you have to make going through. Initially, market profile was a very objective output that defined market activity, inflection points, and defined the economic process that's associated with markets. And today, the market does that by adding time to price. And this is the function of exchanges, is to add times to price. So when I started out in market profile, we traded grains for 3 hours and 45 minutes, and we traded the S&P maybe for 5 hours and the currencies for 5 hours, which was a restricted time frame for people to trade, which forced their orders to come in and provided a more of a base of adding time to price. The second thing the exchange did by having local community as well as professional hedging firms, that they provided time to price by allowing market to meet an equal amount of buying and selling. So, for instance, if there's 1,000 orders to sell and 200 to buy, the market would have to move away from the price rather rapidly in order to fill that imbalance. And with the locals stepping in and taking the 800 deficiency, it kept that price there at the same time. So what we're saying is the price was 2, and there was an order to sell 1,000, and there was only orders to buy 200. The local stepping up would keep the price there at 2. If more orders came in to sell another 2,000, the local stepped up, the price would stay there in terms of time. So basically, that's what the role of the market is, to add time to price. And by adding time to price, all the basic economic functions of the market begin to allow to take place. So what we have today, if we start out, you can see on the screen is where the cursor is. We have a basically typical 313 profile that's in a 24-hour market, and basically a market that where the cursor is that has a perfect 313. In other words, a 313 where we have a defined high and a defined low and area in between usually takes place when nothing is going on today. Okay, so basically when there's not an imbalance in the marketplace, the market basically ends up in this activity. And if you can look at the one from the bottom over here, say the fourth profile, the one before the bottom end, you can see that this one doesn't have the shape of the one that I was pointing to. This one basically is where the market is moving through time, price and time, and doesn't have the liquidity that was evident at the earlier profile. So what we're going to say is that current profile where the cursor is where most of the opportunity is and where the least amount of definition is. And what we're going to do is try to improve the definition where the opportunities are greater than where they were. But if Steve would go back up to the original profile we started at, and I want to point out some of the objective information that we have. So we imagine that the market basically is closed and we're going to open up and begin this profile. Well, how did the market start in that particular format? Well, basically, before the opening, there would be brokers that had buy orders and sell orders, and there would be a net activity, so to speak, more buying and more selling. And then initial stage of the market would open, say, for instance, open 2 or 3 higher. Then that was an opportunity for people to make a trade, which we call an individual trade opportunity, because it was a high price, and that would attract selling and selling time frames of different orders. So then if the market basically happened to come down below the opening range and break 3 cents, then the market would basically be offering buying opportunities, individual buying opportunities. So as the market started out early in the day, we would try to have a high and a low from which to develop a common price. So the market always started with an individual pricing opportunity where the market was high and a person had an opportunity to sell, and an opportunity for a break where the person would have an opportunity to buy. And this was a big economic function because the buying and selling would not take place at the same price. So the buyer and seller would have negated the zero sums, the zero sums being when one person buys and the other person sells, one's going to win and one's going to lose. Early in the development of the profile, the person who is selling has an advantage in the sell price, and the person who is buying on the break has an advantage. And there's a price time difference in between there. In other words, there might be a pricing differential of 3, 4, 5 cents between the seller and the buyer. As the market worked out during the rest of the day, as you can see here, as Steve moves the cursor to the middle of the profile, we're coming down to where individual pricing opportunities aren't there as they were early in the profile, and we have a common price. In other words, we have a price that everybody has to accept. And what I want you to understand is if we go back and say, for instance, I bought the low of the early opening, and you sold the high of the early opening, and we both had profits in it coming into the close. When we came to the close, we're going to look at the assessment of where we think the common price is going to be. Now, the common price basically is a price that is accepted by all. And this is a very important thing, and it's still the common price and individual pricing opportunities are still in the market, but like Warren Buffett's definition of value, it changes over time. So we must find when the market's in a common price area, and we must find when the market's in an individual pricing opportunity. So if you go back and Steve puts his cursor on the high of the original part of the profile, then if you sold a little bit lower than this and put it down there on the R, Steve, you were basically selling a higher price in the marketplace, and your pricing differential may or may not have been correct as it relates to what the eventual high would be. But essentially, if you sold it there and you decided that you wanted to get out of the trade, you would be replaced by another person who had the same idea as you did in terms of wanting to sell the higher opening. So basically, it was sort of a form of liquidity in that a short was being replaced by a short. And same thing on the bottom as we come down to the bottom of the profile. If I bought it there and say the market ended up going 5 lower and I bought it 3 lower and I decided to take a loss of a penny at the 4 price level, I would be replaced with someone like me who thought that that was a buying opportunity. All right, now as we move forward here, the difference in this is a big difference in terms of trading. As we move to the end of the profile and we have a common price, all right, in other words, if I am wrong on this common price and the market scoots up here towards the high of the thing, I have to accept that price. And the other thing is that I have to probably get filled from somebody who was long in the marketplace, because everybody on the short side could see that that wasn't the thing to do, and the shorts are trying to cover, new longs are trying to come in, and what I have to do for my liquidity is basically I need to find somebody who was long at the lower levels down here to sell it to me, which basically is a time differential in terms of leverage. So basically what you want to do when you're trading is you need to make the determination of what is a common price, because the common price forces you to take your loss or stay with your position. So what we want to do is begin to understand the market in the terms I've just described. And 1985, if I would have basically explained market profile in this format, I probably would have done a better job of explaining it to people who could use it. Now, market profile today is, I would say, almost entirely subjective and has very little objective output because of the length of time that the market is open and the lack of professional traders who's willing to take the trade. So our job is to basically begin to find an area where the market is starting, and it always starts with an imbalance, and there's no real opening to do that. So the idea is what we have to do is we've got to find something that equates to an opening or several openings in a 24-hour period, because we're going to have the same type of starting imbalance that we had when the market opened. So the idea then is to take market profile and break it into parts of activity. So the more we're going to try to get into a profile that's more active, we're going to have several profiles take place, and there's going to be more activity that needs to be defined, and for us to again define the value that we find in the original price time equals volume type thing, and the value of the marketplace adding time to price that allows the economic activity to develop. Now, if we come back to this, go back to the profile that's next to the bottom of the page, the market's a lot faster there. And one of the things that you're going to find as a trader is that we make most of our trades when the market is slowed down because we're human beings and we can't get the trade on where we should. And basically, we can't really rely on ourselves getting the fast trade. So when we had market profile at the beginning and the trend days, very few people caught the trend days because they moved faster than we did. And what happens today, the market in terms of price movement is a lot faster than it's ever been, probably the fastest it is. And basically what happens is the economic development that the market should take place lags in terms of development. So this lag in development allows us slower traders to come in and trade the developing economics of the market and take advantage of the opportunities that it prevails, because we're entering the market at a later date than we should be ideally, and that's sort of the way the market works today in terms of doing that. So what we've done in terms of making market profile more fitting to the current times is that Steve will go up to settings, and we will basically change into the formats that we use currently in market profile. And you see on the screen here it says auto split, and Steve will basically click the auto splitter and not bring it up. But now we've activated the market into profile units of minimum period of 12 units. In other words, we're going to have a profile that has a minimum 12 half-hour bars, and in order for it to change over, it has to break the range of the last 9. So what we're saying is that in the nose of the profile, if Steve could move this down a little bit for me, this display, yes, just so I can still see the profile that I started out with. So if you can move, yeah, okay. Now what I'm saying is that as the market develops here, we're going to get our 12 minimum, and then the market will continue to build until it breaks the range of the last 9. So basically, if it breaks the range of the last 9 half-hour bars, we'll get a new profile. Now, these old market profiles are basically chronological time. They're basically when the market starts and when it closed, and there's no time differentiation in the time period. So what we do is we look at the market in terms of its speed. So the idea is a profile that changes right at 12 and right at 9, and one that has a lot of activity. A profile that can go up to 15, 20, 30 half-hour bars is one with a little activity. So what we're able to do with this basic format is to basically change it into a multiple profile format. So Steve will bring these up and we'll see the same differentials. So click OK on this and we'll change this format to
Notice
the new profile design.
Notice the dates across the top. Each profile is a day, correct?
Steve, change the profile. Go hit OK. Okay, good. Now what we're going to see is that we have the same shape of market profile, but we're getting multiple profiles during the day. So this is the 29th, and this is still the 29th, and this is a partial 29th and 30th, and then we have a 30th and a 30th and a 30th. So you notice that when the market was moving sideways here, we basically had less activity than when the market was moving down. So what we're looking for here in terms of the market is basically the starting and stopping points from the marketplace that caused by imbalances. Okay, so remember back in the old days when the market opened, we would have an initial imbalance because there'd be more buying than selling, and the market would open higher or lower. And basically, we have designed this. Then, if we break the range of the last 9 profiles, it's basically an imbalance, and we start again. So we're trying to start these profiles on imbalances, and the more profiles we get, the better, the more active the market is. The least amount of profiles is that the market is basically not having much activity. So that's a little clue that you're looking for as we go forward. All right, now what we're going to do is that once we have the profiles, we're going to be able to determine something that it relates to the speed of the market. So this is something that Steve has developed over the last couple of weeks, and it's a piece of information we've had for a long, long period of time, but we never displayed it in a way that we're displaying it now. And I want to point out its importance to you in terms of reading the order flow coming on the screen. So what we're going to see in these profiles is that you can see these little parentheses, and there's a number in there. And like in this number here says 6, okay, and the previous one was 18. So the idea, the speed of the market has really picked up here. Now, we said the speed of the market always changes because of the order flow. So remember I said if there's 1,000 for sale and not much buying, the market's got to move away from that price pretty fast. If there's 1,000 for sale and 1,000 for buy, the market's going to stay at the same price. So our job, when you look at this, you're going to see that if you go back to the first number here, we have 14, and then we have 10, and then we have 12, and then we have 18, and then we have 6, and then we have 10, and then we have 13, and then we have 10, and now we have 14. So this is all caused by the order flow imbalance that triggered the new profiles that would be there. So we can then see from this format have some reflective idea on how the order flow is coming into the marketplace and what the response of the market is going to be, okay? And so these are very, very important things, and we're looking, whenever the market speeds up, we are inclined to basically go with the direction of the market. So if we look at the market here, and this is 14 where the red bars are, and then we have 10, and then we have 12. Basically, we're looking for the market to change at a faster rate. So when it comes down, basically it comes down pretty fast here. So the order flow was really high here, and then down to this lower level, we basically have found a price support level that came into the marketplace. Okay, and then the market moved forward to a new profile because the imbalance had changed from here. So the market was sort of balanced here, and then it's imbalanced again and moves down to the downside. Again to the market. So what you're looking for is that this order flow imbalance that's all over the lot in a 24-hour market is very important for us to understand what is the speed of the market, because it tells us how many orders are coming in to buy or sell that doesn't have the other side on its side. So we'll get more into that as we go along. And the last thing that we want to introduce here is you're going to see the red bars that are basically taking place in the marketplace. So we have some red bars in this profile, and a red bar on that profile, and a red bar on this profile, and some red bars here. Okay, if we go back then to the settings, and Steve brings up our program, you're going to see down at the bottom it says volume iterator. Okay, it's the high volume periods within the specified look back bars will be colored red and all others green. This optimum overrides all other color selections. So we're taking a look at 300 half-hour bars as a sample size where the market is going through. And so this sample will go back in 300 bars. It will then take the high 20 volume period bars and color them red. So we know that then the volume is basically high at this level with both the buyers and sellers involved, because there is a buyer and seller for each contract. Now, the important thing in terms of this is understanding that the liquidity of the marketplace today is basically voluntary. In other words, it's a volunteer liquidity. So as the market's breaking and there's 5,000 to sell and nothing to buy, the people who become the buyers volunteer. In other words, they come off the bench basically to trade that opportunity. All right, and what we're going to do is we want to make a standard viewing of that. We're saying is that the event that basically is causing the market to break, when it finds the voluntary liquidity, the voluntary liquidity is going to be greater than the event. And that's just an assumption that we're making. It doesn't always hold the case. But this goes back to a long, long time ago, 1964, when I was on the floor of the Board of Trade, when the markets were not that active, and there was probably trading 6,000 contracts a day of all contracts. And I happened to be trading in the corn pit at the time, and all of a sudden, about 12:30, the market really gets busy in beans, and it was a bedlam on the floor. It was unbelievably like someone brought a band in compared to the past. And I noticed that at 12:30, that the soybeans, to date myself, were trading at 251 3/4. And after this bedlam, which was basically till 1 o'clock, the market went up to 252 1/8. And then about 10 after 1, it was trading at 251 5/8. So at this particular point, I said to myself, if all the king's men and all the king's horses have marched here and market didn't rally, what are the chances of getting an event bigger than this in tomorrow or the next day? The odds were that that wasn't going to happen, so I went over and sold the market, and that was the correct thing to do because a month later it was about 10 cents lower. All right, now I then took this example to the everyday markets when, say, 1965 or 66. I really wasn't a very talented day trader, but I realized that when the market opened lower by the orders that were causing the imbalance, that the liquidity level of the exchange was going to be big enough to hold the market temporarily where I could take a look. And basically, I assumed that the liquidity on the floor would be greater than the event, and that's really been something that I've used all my life since that day. So here I am in trading 50 years. I've been using that all along. All right, so now we come back and we take this thing, cancel this, and take it off and just leave it on the screen. We're going to see how we can use this to help us. Okay, so what we have here is we have some very high buying and selling activity at this level of the marketplace. Okay, we're basically saying where the half-hour bars are red, there's a very big activity on both the buy and sell side. And when you have a lot of activity, what's going to happen is, and a lot of people entering the market and buying and selling the market there, one person is going to be right and one group of people are going to be wrong. So the idea is for us to be aware that there's a tremendous amount of activity taking place here, and the idea that this is information that we probably can't make the trade here. So when this market basically is trading up here in D period, it's a great sale, but I don't know to sell it when it's basically happening, do I? I mean, I have no idea that it's going to turn out like that. But basically remember that the development of the market is slower than the price action. So the idea is what I'm looking at here is I'm going back to my example, all the king's men and all the king's men have bought and sold this. Somebody is going to be right or wrong. So as we move out here later in time, I can say, okay, well, I feel that the market is speeding up to the downside here, and on the fourth profile that starts down, and the people that basically bought it here are going to be wrong, and since they basically are a higher percentage of people trading because the buyers and sellers in the half-hour bar are one of the top 20, there's going to be some liquidation when the market gets underneath that, and the amount of buying here as the market starts down is not going to be equal to what it's there, so the market has to go down to do that. All right, and so then we get the half-hour bars here where the new buying came in at the bottom of the market. Now again, I don't really have to make the trade right into the teeth of that, but I can use the slower developing economics of the marketplace to take advantage of this. So again, I'm saying is, okay, here's where the latest bit of big open interest is in terms of trading. And as the market basically takes out the low side, I'm going to do it again, right? So do that. So anyway, this is one methodology of using the high volume data that we have in our iterator. And then what you're looking for is how to bring all this stuff together, okay, in terms of the profiles so that we can make rational decisions going forward. So basically I want to point out here on this profile that down where Steve has his cursor is the market is reaching price control down here because there's 18 in the small little bars here. So that means the market has reached the balance here that people have come in and necessarily bought the marketplace, okay? Now what we're looking at here in terms of the market is that we're going to look at what is an individual pricing opportunity or more or less a common price, okay? Now, most of us would not be able to make a trade in this teeth of the onslaught as the market moves down, and most of us would be able to make any trade in this area. So what I look at is that if the fast part of the market in this profile, which is the red bars, okay, this is what the fast part of the market is. This is the slow part of the market. When they're the same, we have a common price, okay? When they're the same, that we have a common price, that one price for all rules in terms of the marketplace, okay? And as we go back even to the third profile here, what we have is, since the first red profile and the second and third profiles, is that we basically have the time for people to enter. So the fast people and the slow people are together. and I'm one of the slow people. So basically, we have a common price. That means, like the close of the market, I mean, you're going to have to accept what the other person does. Now, as the market starts down here, and the people that are long, there's going to be no new buyers stepping into the fray here for them. They have to hope that somebody that sold up here has a resting order down there that they can hit in terms of activity. So what we're looking at in terms of the market is that we're looking for opportunities that where the fast traders and the slow traders come together, and that gives us a common price that everybody has to accept. And we're going to look at a couple other profiles where there's differentials. So the idea is that hypothetically in the first three profiles, we could basically have a selling zone up there. This is the only zone where people are going to sell. And then down here at the bottom of the last profile, that becomes a pricing opportunity if people are buying down. So move down to the last three profiles, Steve. Okay, and we'll say that's a buying opportunity. Okay, so then that equates back to what I told you with the start of the first profile, where the market opens higher and you have a selling opportunity, and where it opens lower, you have an individual pricing opportunity, contrasting to the fourth profile here where we have common prices. So one of the things you have to realize when you make a trade is there a differential between where the people are willing to sell the market and a differential where people looking to buy the market. So what I look for then is a differential, which you'll see in another profile. So Steve, bring up another profit profile here and put it in the same format. Okay, and break it into the thing again. Okay, and again, what you're looking at here in terms of market activity, and bring the screen up a little bit. All right, now what we're looking at here is down here in this G period, this period, you would assign this heavy activity to buying, give them an advantage, okay? And as the market moves sideways, we had buying again here at this level, right? Okay, so we could say then at the price level of 114.12 to 30 is a buy zone in the market, and we really haven't found any selling activity in the market, have we, in terms of this. So if we go up to where the market is slow, so the market starts to get slow up here, so we're going to say then this is a sell zone in the market activity. So the third and second profile from the end, Steve. Yeah, okay, those two. Okay, so that's where the profiles are getting fatter, where people can come in and make the trade, and the market is slowing down. So that would be a differential where the selling is coming into the market at the level of around 15.10 to 15.30. Okay, so then as the market then drops back down to this level on the last profile where it's red at the bottom, all right, you can anticipate then that this is the bottom of the E there of this profile, right? If you look at that profile, that zone, that's down into the buying zone away from the selling zone. So if we take the selling zone as an average of the first two profiles preceding it here, then we're basically making a trade at the beginning of the profile where you have an individual pricing opportunity. And this is one where opportunities where even if the profile hasn't turned red, you want to take a chance here because you're buying where the buying and the selling in the marketplace have been separated. So where the buying and the selling have been separated is an individual pricing opportunity. Where the buying and selling come together, basically it's a common opportunity. Now notice that in this market here is that what we have is the market is moving a lot faster here in this development, and the idea is you didn't have much of a chance to buy this here, but the idea is even if you didn't buy in this area, you want to take a chance because the idea is that the market has bounced off the buying zone, so we have a lot of people wanting to buy here, and then very few people wanting to sell here because we didn't get very much selling was red. So the market's going to have to scoot up here, and what it's looking for is somebody who's going to come in and sell this price, okay? Now, what you're looking for here is if you sold down here going short, you have very little time which to cover your trade, because what you have is you're in a buying zone, and then when you move higher up here to the H and I period, the people who sold in the previous two profiles are going to be deciding to get in. So you don't have a lot of people wanting to sell the higher price in this example, and you have basically no one coming in to sell it, so the market's moving quickly through time. And what we're going to try to emphasize is making the profit in this last profile is going to dwarf whatever you make in here. And what you have to remember is that the assumption that we make in terms of trading is that we're slow, okay, and we have to trade where the market slows down more often than not. And then we want to do is evaluate that slow area as it relates to being a common price or individual pricing opportunity level. And the market will offer both types of environment. So as you go forward in terms of the data, it's very important that you understand that in the market today that the market's going to start and stop on the imbalances that we, just like we had at the opening. In a 24-hour market, they're going to occur where they occur. Our job is to find and delineate those, and we do that by several methods. We basically do that by splitting the profile into a minimum profile that will change on any imbalance by breaking the market, breaks the range the last 9. We basically show the speed of the market in terms of the numbers in parentheses, and we show the imbalances that were very similar to the opening imbalances and the opening imbalances of the marketplace in terms of individual pricing opportunity. So in a sense, I'm doing the same thing that I did in 1964 when I made the assumption about Humpty Dumpty when the beans went from 1 3/4 to 2 1/8. But it's much harder to do today because you have to find that. But understanding then the objective reads of the market allows us to basically decide whether we want to buy or sell, how much we want to buy or sell. And we are basically then understanding how the market's evolving, what the economics of the market are, and basically I found that one of the real keys to my success was that I changed my methodology all the time as the market changes. And this is probably the key to my success, is that right now for this year, I'm just up a little bit for the year, but I'm trading entirely different than I did last year because I think it's a better way to trade. So I'm constantly working on doing that and understanding the ebb and flow of the markets as they currently are occurring. And trading is a very difficult industry. And I remember when I joined the Board of Trade in 1963, one of the questions the committee asked me was, why would a person of my education choose to be in the trading industry? And my response was that nobody was any good at it, so I wasn't at a disadvantage. Not that I was going to be good at it, but the idea no one was really that good at it, so there was an opportunity for me to succeed. And I would say the same thing happened today across the world. No one is really good at this. There's lots of different ways of doing it. Your success depends upon your own abilities. And I think that trading will be the biggest industry in the world because it offers so much. It's probably the least understood business there is with the greatest opportunity. So I would say that I encourage all of you to work hard, understand the markets, and try to develop the skills that you can do. And I would say that in my career, going back 50 years, that all the good trades, I had very nebulous activity and a very nebulous type of data to go on. So all the good trades are really data lean, so to speak. All the bad trades are lots of data. So again, trading is sort of against our natural instincts, and I think that you begin to look at the market in terms of what it does economically, what are the disadvantages, what are the advantages, and you have to trade with advantage over a period of time. So what I've showed you is the way that I'm not talking down to you, I'm actually talking up to you because this is what I'm doing right now. And I realize it's difficult for a lot of people to understand, but I'm saying is I'm putting you on the path that if you don't understand what the market is doing and how it is doing it, you're going to have a very difficult time succeeding over a long period of time. So with that, we'll open it up for questions here because I've taken most of my time, and Steve will be filtering out the questions. There's a lot more I could do here, but I tried to leave you with a couple ideas. I want you to understand when you make a trade, whether it's a common price or individual pricing opportunity trade. If you can make that distinction, I think you will do well. By merging, the idea is that right here in this last profile, this is fast activity. We don't have the slow activity coming in here yet, do we? So the idea is we all not going to be able to trade at the fast opportunity. So we're going to be making our trades in the areas like this where the market slows down. And as you go back and look at these profiles that have, 12 or 14 half-hour bars in it, is where most of our activity takes place because the market's moving too quick for us, okay? And that's something that's always going to be the case. So with that, I want to leave you with the idea that the idea of understanding the order flow coming from these little parens is a very big thing, because the order flow is going to give you reads. There's a lot more I can discuss about it, but I'm just trying to show you that the order flow imbalances that take place in the market today are very wide and different, and you need to understand this in order to do your trading successfully, that the market is getting a lot of selling right now and it's not breaking, or the market's getting a lot of buying right now and it's not rallying. These are all things that come from your gut, so to speak, in terms of trading, and I think that what I've showed you today will be somewhat helpful initially, and as you get into it more, it'll be very helpful for you as you go forward your trading careers. So I want to basically sign off to say goodbye to all of you. Thank you for listening, and I want to thank everybody that presented this, and we'll go into the questions.
Okay, one question here. More clarity on these numbers and.
I can't hear you that well, Steve. I can't hear you, Steve. I can't hear your question, Steve.
Hey, Peter, I don't hear him either. Steve, did you click a button or something? I don't know if he disconnected himself or what. I apologize, everyone online.
Well, could you get the,
he's got, he's muted himself. Steve, if you can hear me, unmute yourself. I don't know. I don't know what happened. I can't see the questions either, unfortunately, because he's got the control of the desktop.
Okay. Okay, so now here's the questions coming in, I guess.
Okay, I think I can see the questions then. Okay, let's see. How do you set up market profile in Bloomberg?
I'm not familiar with the Bloomberg thing, but basically they haven't licensed our new methodology where we basically we call the splitter, where we break the profile down into 12 minimum bars and then breaking the last 9. So we have a time variable profile rather than a market profile. It's different.
Okay.
So there's a difference between what we presented here today and market profile.
Okay. Here's a question on the where can they learn more about the basics, like what do the letters mean? So some real fundamental information.
That would be probably any book on market profile basically explains that in terms of half-hour bars, and they're progressive through the day. So A period is followed by B period, and it's a half-hour bar period put into a bell curve, which means that the market's able to show time because of the wraparound process. So that's in almost any market profile book. That's explained.
Okay. Let's see. What are your thoughts on volume profile versus market profile?
The volume profile, basically what I've said here, you have to limit the volumes in order to see the high volume. So looking at the volume in all different magnitudes is not what you should do. So in our profile, we add in our volume iterator the 20 biggest bars because they're significant. And basically it gives you a focus on the market, and where the heaviest bars are is where the most activity is, and you want to concentrate on that. So in a volume profile takes all the volume in, does not offer any distinction that you can, probably it's too noisy to do much with.
Okay. There's a question on breakout periods. They just wanted you to go over that quickly if you can. I know you covered it already.
Okay, a breakout period in our profile would be basically where the market speeds up. In other words, where we have a 10 in half-hour bar parentheses, and the market is moving down on less than that. That would be a breakout period, because the market moves when there's basically more selling than buying, or more buying than selling. So the market's going to tip that off by moving fast in that thing. So whenever the market speeds up in terms of providing more profiles or faster profiles, we know the order flow is there.
Okay. There's a question about the minimum of 12 periods, but some of the numbers in the parentheses were less than 12. Why is that?
Yes, right. In other words, we're talking that's a very good question. It's confusing to people who are not familiar with what we're doing, and I'll try to answer it. In the profile that we look at in the 12-9, we're saying a minimum of 12 half-hour bars has to take place in a unit of activity. When we're measuring the center of the profile, which is the widest point in it, it does not necessarily equal that. So in other words, we can have 25 in the profile and only be 6 wide. So the number in parentheses is how wide the profile is, and that tells market time. So if you look at a bar chart or any other thing, time is measured horizontally. So we take the high TPO line, that's time price opportunity line, in a profile, and measure how far it is. Okay, so if 1 is 10 across horizontally and 1 is 8, okay, then the 8 is faster than the 10. If the market is 12, it's slower than the 10, and the number is measured by how many half-hour bar letters are in that price line. So, for instance, if the high of the market is 10 and the low is 0, and the midpoint is 5, and we had 5 of those different time periods trade in at one price, then the numbers in parentheses would be that number of times it traded at that high TPO line. In other words, the price that has the most letters in it horizontally is the one we measure there. But that's a very good question, and it's a confusing question to new people.
Okay. Here's one about volume strips that they've heard you speak about in the past. How does this what you talked about today relate to the volume strips?
The volume strips are a much different program in terms of defining volume, and what we do there is the issue with the volume strips is to start and restart the volume at different levels. So, for instance, the volume strips allows you to basically have the market trade for an hour, so to speak, or less than that. It doesn't make any difference. And what you do is you basically reduce the market down to the high volume number, and then you basically start over again. So what you do with volume strips is start volume all day long. In other words, that you can then look at different sections of market activity. So you can see that we had a heavy volume for the first 2 hours of the day, what the high volume price was, how the new volume's coming in and trading to that. So is it trading at the same price level? Is it trading higher than? Is it trading lower than? And how much volume is there? So we can basically make trades at volume levels. So you can say, okay, if there's 5,000 traded in sugar at a certain price, buy or sell it. So we have a whole new way of looking at the markets in terms of entering and exiting based on volume rather than price, and it gives you the idea of the market slowing down. So if, say, the market breaks 20 ticks and there's the biggest, highest volume in any one of the prices coming down, and the 20 ticks is less than 100. So you can say, okay, as soon as we get 300 at some price, I realize we have price control. So you can put your order in to buy when that gets 300. So it's a much different approach to the market, and one that's completely valid, and one that I just developed a couple of years ago, and I really haven't done too much more than develop it, and we're working on that. And then, but it's much different than the volume iterator. The volume iterator shows the imbalance of heavy volume in relationship to where the volume is light. So basically, fast, slow is what we get with the volume iterator, and we just get quantities in relationship to themselves as the market develops with the volume iterator.
Okay. There's a question here about, has high-frequency trading changed the market profile?
Yes, it has, because what changed it more is 24-hour trading. So the idea is that there's no real central time around which markets can evolve and trade. Where we looked at the market in 1985, when I did this, we had 3 hours and 45 minutes for soybeans and 5 hours for S&P and currencies. Okay, then basically all trade was confined to that period. So the market would open higher or lower, expressing the imbalance of the rest of the time when the market wasn't trading. So if the market was closed and there was news out, we have buying or selling related to that news for the next day's opening. In today's market, we are open 23 plus hours. We get that when it happens. And so there's a much different thing because of time, not so much because of high frequency trading. We need to have a lot more high frequency trading to add time to price. So it's really the 24-hour format that basically has changed the market dramatically, not the order flow.
Okay, that makes sense. There's a lot of questions. I know we're running out of time. I'll try to get to as many as I can. There's a question on the red letters. Are they high selling?
Are they what?
High. It says high selling. I'm not sure.
Oh yeah. Well, no, it is. In other words, what you're able to do. That's a very good question. The red letters represent the highest bars, 20 bars in the 300 bar sample, and they're comprised of both buyers and sellers. In other words, to have a trade, you got to have buyer or seller. So it's a high activity area in the marketplace. Now, what happens with the voluntary liquidity is these are going to occur on the extremes of the market more than the middle of the market, because the idea is that the opportunity is there so the market comes down sharply, you have a whole bunch of people want to rush in to buy it. So basically it is buying or selling, but the idea in sufficient quantity that it states that it was an imbalance that basically was reacted to by a large number of participants in the trade. Then you would take a look at this and say, even if you don't trade at that particular area, you can use it as a reference, because if it's a big area where most people have traded, one group is going to, either the longs or the short are going to be right or wrong, and the market's going to move away from it. So I don't necessarily make the trade right into the teeth of the red bars. I use it a little later, because the development of the market, where the market is slower, I can make my trade against the high and low of those areas. But the person is correct. It's going to be high buying or high selling, and that adds to the fact that the event is going to be smaller than the voluntary liquidity. So if the market moved higher and people sold it because the market was so much higher, they have the advantage of the high price helping them, and that basically helps the assumption that the event is going to be smaller than the liquidity. So it's a very good question.
Okay. You want to take a couple more? Is that okay, Peter?
Sure, whatever you go.
Okay. There's a question on the auto splitter, and they're saying that minimum periods, is that for horizontal development and breakout periods are vertical development? Does that make sense?
That's correct. But not, I won't say it's correct. The 12 or 9 is basically a small unit that can basically not get any smaller. It can only get larger. So we set that up so that many times we'll get a 12-9 profile, which means the market is moving fast, because it's basically taking out the range of the last 9 right away. If the market's moving slower, breaking the range of the last 9 is going to be more difficult. If the market opened real high and real low in a new profile, it's going to build more volume, because it can't take the high and low out and starting out. But then as we go forward, we drop the high and drop the low to the last 9, which makes it easy for the market to transfer. So basically we're saying is we have a minimal unit that only can get larger. So then on a relative basis, larger may be 15, and the next one may be 16, and the next one may be 12. So the variance basically in the size of the profile is very important as it defines market activity, because when there's activity, the market's moving. Okay, I mean it's moving directionally. When there's no activity, it's staying the same price. So what you see today is that the profiles where the market is accumulating time are difficult to trade, because the market is in neutral position. It can go either way. In other words, it can go up or go down once it's in neutral position. If you're basically trading against the high volume point where it's not taking that out, then you're shading that neutral position to the downside, because it's not going to take out the high volume area. So the idea is there's all sorts of information coming from the data, and it's the minimal unit that we express. So the minimum unit is going to be fast, okay, and you get quite a few of those. And the fatter units that have more bars in it are going to be where the market is slowed down. And essentially what I'm saying is a 12-9 unit is real fast, but it's also slow enough that I can trade inside that unit. So if I was trading a red half-hour bar, the market would be harder to trade because I'd have to be right there when it happened. If I'm trading a 12-9 unit as fast, there's plenty of time for me to trade.
Okay, good. I'm just going to try to find one or two more because there are a lot of questions here, which is a great sign, and obviously people are very interested in this method and finding out a lot more about it. Let's see. You've covered a lot of the questions that have come in lately. Okay, it says, I've heard you say time does not retrace. Can you talk more about that?
Yes, that's true. Okay, time does not retrace. Okay, price retraces. So the idea is that the imbalance in the marketplace, why exchanges were formed in the first place, was as an inelasticity of supply, not price. Most markets trade on supply. If you're going to make money, you have to have supply on. In other words, the idea of trading is to have more on your right, less on your wrong. So supply is a big part of market activity. Okay, so if there's an order coming in to sell 1,000 contracts, then basically there's nothing there to buy, the market's going to move really fast, isn't it? So it's going to move away from that price quickly in terms of that. So what we're looking at is that time has leverage over price. So if you're trading in a price-controlled market and the market's trading between, say, 0 and 10, you're going to be making small little ticks, 3 ticks, 4 ticks, 5 ticks, because price and price to price is a non-leveraged return. When there's a shortage of buying, so say, for instance, there's 1,000 to buy, nothing for sale, the market's going to move more than 4 ticks to get filled, okay? And as a trader, you have to have time on your side because you can't have that leverage against you. So the idea is that if you want to cover and you'd like to cover, a lot of times you can't get in because the market's moving quicker than and there's no availability. So you might end up in that particular case taking a 10, 12, 15 tick loss when you wanted to take a 2 or 3 tick loss because the time has leverage over price. So if there is a basic imbalance of buy and sell orders, then time has to correct that, and the market moves rapidly to do that. So what I'm saying is if you have more sellers than buyers, the market has to go down to get a volunteer to come off the bench to buy that order, and that causes the market to move rapidly. So you want to trade time because time equates to supply, and when we had price market profile in the 85, price and time were equal. So basically you could trade price or you could trade time because there was no difference between them because the exchange added time to price. When we basically moved to 24 hours and we moved to having less local liquidity because of the time frame, basically what you find is that time is the element that controls the market today because of supply. So then what we have today with another thing is that the unrelated part of the market activity. So if there's an order to sell 1,000 and the guy sells it, okay, that's just 1,000. Someone come in and buy 5,000 and push it right back up. We don't have the overall consensus of the price for all. So if there's 100,000 people long and the market's going lower, you have 100,000 people that want to sell during the next week or so. But if you have an order imbalance we have today in 24-hour markets where the market doesn't have a big open interest because it cleanses itself so often, then if you sell 1,000, it breaks the market. It's over when it's over. So the idea of retracement and relationships to highs and lows in terms of price is all blown out today. It doesn't have any meaning as it did in the past.
Okay. Let's do maybe 2 more here. There was a question on which products you were showing today. I know you showed the dollar index, you showed the Russell. What was the third product that you showed?
I think we had the dollar index, Russell, and crude, Brent crude.
Okay, right. Okay, good. And then related to that, do you change 12.9 for different products?
No, I don't, but you have the right to do that. When we first started out doing this was 1994, and we started out with 23 and 5, okay, and then it's evolved over a period of time, the last 18 years, that with 12.9 is the best unit, and we've gone down to the low of like 8 and 2, and I say 23 and 5, and through just experience and that we've come to 12.9, and I really think it's a real good unit because it's fast enough. I mean, it's slower than the market, which allows me to trade in the unit, and fast is relate to other profile units. So the idea, if I have to trade the extremes of market activity, the highs and lows, you got very little time to go in and make the trade. So the real basic part of the unit is one that represents the speed of the market and still allows me to trade as a slow older guy.
Well, a lot of people are asking, will we be doing further webinars? That's really going to be up to you, Peter.
Glad to do this because this is
we'd
a
love
new
to
thing,
do it
and
again.
I'm trying to get people out understanding that their market profile has changed, and market profile is no longer, completely objective. It's really completely subjective, and it's a very good thing, even in subjective format, because it allows a person to get a feel of what he's doing. But the idea in trading is you have to have objective information to assess, and you don't have to accept it, but you need to do that. If your whole data source is subjective, you're really not really a trader. You're more of an investor. So the key thing is to find hard, objective data that you can assess. Not necessarily that you can have all objective data says buy, and if that everybody's done it, the market is at the top. So the idea is that you're not going to follow the objective data, except that it gives you a standard for which to measure what's going on in terms of market activity. So I said, okay, we're getting a lot of volume here right now, but the market's not rallying. I could say, okay, then I should look to sell it, right? And that's sort of a common thing that people would do. So you look at the response to what you have from an objective standpoint. So a lot of buying does not necessarily mean that you're going to buy the market. A lot of buying that basically is not pushing the market up is a sale. A little bit of buying that causes the market to move sharply up is a better type of thing. And I said, going back in 50 years of trading, almost all the good trades were nebulous in terms of data. They were, in other words, they were lean on data and more on courage than doing that, because that was the reason no one else had it, and that's why it worked.
Okay, great. Well, that's a good place to stop here. We'd love to do more webinars with you on deeper dive into your method of trading and maybe some other products. Do you want to say anything, Peter, to wrap up?
Well, I thank everybody for listening, and I'm trying to say you may be confused, but I'm not talking down to you in terms of, trying to take you to the low level. I'm expressing exactly to you what I'm doing today and what I'm looking at, and I think that, I'm going to be a little bit over your head sometimes, but the idea is that I want you to point out, to be successful in trading, you've got to do it yourself, and you have to grab an understanding of the market. And in doing that, you're putting yourself in a good position to go forward, because there's not a lot of experts in this field. And even though I've been at it 50 years, there's a high turnover. So the key thing that for you to be successful in the future is understand that markets change. Just like Warren Buffett defines value a lot different than he did 25 years, 50 years ago, but it's still value, so he's still trading on value. So to find the things that you need to trade are in the marketplace, but they're just covered up in noise, and you have to come to find the fundamentals. Is that you like I say, the biggest thing you can do is determine whether your trade is an individual pricing opportunity or whether it's a common price you have to accept by all. If you can make that distinction, you're going to be steps ahead of finding people, of being ahead of people in terms of trading and your success. So it's make that distinction, which is a basic distinction we made when we were on the trading floor. If you can begin to make that distinction any way possible, you're going to be a lot more successful than you are